Hello everyone. So today we're going to be diving deeper into the Forex basics. The other time we explained what a market is and what Forex trading is. So today we're going to be seeing how to actually make money in the Forex market. We should already be familiar with this slide. The 7 steps to becoming a successful trader. This will just help you know where you are. The first step is the basics. Then the next is technical analysis or fundamental analysis, or you can combine the two. We're going to be learning about fundamental analysis in today's lecture. This second part just tells you how you analyze the market. But this mentorship is based majorly on technical analysis, how to analyze the market technically. Then from there, you'll be able to obtain a very good strategy about which you backtest, then get a unique trading system to your personality, demo trade, which will help your psychology. Then you can be able to go into live trades. So now we're going to talk about the financial instruments. Financial instruments are simply instruments that provide a platform for trading asset classes, financial assets. Now, I want us to understand that Forex or foreign exchange is an example of different asset classes. Other examples include bonds, shares, real estate, commodities, even cryptocurrencies, an example of an asset class. Now, we have different instruments here listed. We have features, we have options, we have exchange traded funds, and then we have spot FX. Spot FX can be divided into 3: retail forex, CFD, which is contract for difference, spread bets. Okay, so I'm going to be explaining each of these instruments just to give an overview of this instrument that can be used in trading the forex market. All right. Features. Features are contract with the obligation to buy or sell an asset at a predetermined price and date in the future. So features is just an agreement between two people, a contract where two people agree to buy and sell an asset at a future date. That's where the word features come into play. Let me give an example. Let's say you're a farmer and then you plant cocoyam. Now, you don't know what the price of cocoyam would be in the next, let's say, 7 months. Many things could occur. Let's say drought breaks out and then the cost of production increases, which would then drive the price high for cocoyam. For me, as a buyer who wants to buy cocoyam, I am scared of what could happen to the price of cocoyam in the future. But the price it is selling now is a price that I'm comfortable with. So what happens is that I come to you and then we agree on a price that, okay, I need a certain amount of cocoyam, but I don't need it now. I need it later. But I'm scared of waiting to that time to buy it because the price might have increased. So what will happen is that we'll agree that I'll buy this amount of cocoyam from you at this set date and at this agreed price. So what will happen is that you, the farmer, will come to an agreement with me and say, okay, this amount of cocoyam will be sold to me at this also price, at this also date. So no matter what happens to the price of cocoyam, I'm going to buy this amount of cocoyam at the agreed price. So that's what features it. So it's a contract between two people with the agreement to buy and sell an asset at a predetermined date. Now note something. It is the obligation. So you must buy it. Once this contract is signed, it must be bought and it must be sold. If I am buying for you, I must buy it at that price. And then if you are the one selling, it's a contract, it's signed. Then now, which will now lead me to options. Option is the same thing with features. The only difference is that you have the right or the option to go ahead with this contract. With features, you are obligated, but with options, you are not obligated. So I'll read this here. An option is a financial instrument that gives the buyer the right or the option, but not the obligation to buy or sell an asset at a specified price on the option's expiration date. Okay, I will still use the previous example of you being the farmer and producing cocoyam. Now I walk up to you and I tell you that let's sign a contract. And this contract includes me buying cocoyam from you at $1 per cocoyam. So one cocoyam is equivalent to $1. And then I plan to buy it in the next 7 months. I don't need the cocoyam now. I need it later. So because I'm scared that the price might change and I'm suspecting that it might rise in value, I don't want to buy cocoyam at that huge amount of money in the future. I want to buy it at an agreed price so that I will hedge against risks. So fast forward to 7 months, the price of cocoyam is $1 for 2 cocoyam, meaning it's cheaper. Now, because it's options, I can opt out of that contract. I am not obligated to go ahead with that contract. I can say, okay, I have seen that cocoyam is selling lower than the agreed price, and I would want to buy it cheaper. Since I have the opportunity to just do that, why will I buy it $1 per cocoyam when I can buy it $1 per 2 cocoyam? So I don't know if you understand the difference now. Futures and options are two different financial instruments. Now, spot. Spot refers to the current market price of an asset, which is the price at which the asset can be bought or sold for immediate delivery. So it's very simple. Just like you go to a provision store to buy biscuits. You buy the biscuit at that price and they give it to you at that moment. So people also buy and sell currencies, if you understand. Like businesses, banks, government, they exchange currencies. They say, okay, if the rate of $1 is equivalent to 1,400 naira, so give me so amount of naira, and then they'll pay in dollars, or they want to buy dollar, they pay in naira. It's very simple. So at that spot, you are buying the physical assets. You are buying it, if you understand. You are buying the physical assets. So Forex can be traded in this form. And then it takes 2 to 3 business days for this transaction to be completed. Then we have the exchange traded funds. And the ETFs are investment funds traded on stock exchange that hold assets such as stocks, but this is just a basket of stocks and shares that you can also trade in a stock exchange. So just to give an overview, now we have retail Forex. Retail Forex refers to the practice of individual traders buying and selling foreign currency through. So we know if we go back to the image here, we can see that the spot. So there are actually majorly four financial instruments that we can trade different asset classes. We have futures, options, ETFs, and then spot Forex. So from this spot Forex divided into 3, this is the major one we're going to talk about today. But just to give an overview of everything, we'll talk about retail Forex and spread bet. So let's move on. So retail Forex refers to the practice of So retail Forex refers to the practice of individual traders buying and selling foreign currencies through an online trading platform provided by a broker. So a broker is the interface between the buyer and the seller. As this course continues, we're going to learn much more about a broker, who a broker is, what a brokerage firm is, what do they do, what's their function, how to get a good broker. So it's just a middleman facilitating the buying and selling between 2 traders. Very, very simple. Then CFD. A CFD is essentially a contract between 2 parties, the buyer and seller, to exchange the difference in the asset price between the time the contract is open and closed. It's a contract where 2 people agree. Let's take, for instance, me and you, we come together and then we agree, Euro USD. You say that Euro USD will go high in value. Let's say Euro USD is trading at $5 per unit. And then you say that it will go high in value. Then I'll say, okay, I'll take the other side of the bet. If it goes high in value, I'll pay you the difference from where it is now to where it gets to. But if it goes down in value, you pay me the difference of where it is now to where it gets to. Simply put, if Euro USD moves from $5 per unit to $10 per unit, that is the increase in price, I'll give you $5. But if it goes down from $5 to $0, just for example, please, or let's say it goes to $3 per unit, you will now pay me the difference of $2. So that's what that contract explains. And then this is what we actually do with the broker. Okay. So Forex bet, very simple. It's just like a bet. This one you're not actually trading. Let me just read it out. Forex spread betting is a form of financial spread betting, where traders can bet on the price movement of currency pairs without having to physically own the currency. It is essentially a way of speculating on the performance of Forex market without actually buying or selling any currency. Well, in the US, spread betting is considered illegal. So this is just simply betting. Many of us know about Nigeria bet, but this sort of have a level of speculation where people come together to determine where we price move. They don't actually buy or sell anything. They just bet. If they win, they get their great profit. If they lose their money. Okay, now I've spoken about the different ways to trade currencies. Futures is a contract where two people come together to agree on purchasing an asset class in the future date, and they are obligated to go through with that transaction. Options, they are not obligated to go through. ETF, this has to do with a basket of shares and commodities, etc. And it is traded through an exchange. Then now spot FX, which is our focus. There are three types. We have retail Forex, we have CFD, and they have spread betting. And I'm sure we have a good understanding of these three. Retail Forex is you buying a currency from another individual, but through a broker. A broker is standing as the middleman. Then CFD is contract for difference. A contract where I speculate price of either going high or going low, and then I'm paid for the difference. Then spread bet is just like betting. We don't really need to know much about this, but this is our focus today. This is our focus today. So now, what I will bring to our attention is features, options, and every other thing here. They actually trade the physical assets. If I come to an agreement with a farmer to get cocoyam delivered to me, what happened is that at that so date, at that specified date, I will get cocoyam delivered to me. But now we are trading currencies. If I buy currency at a specified price to receive it at a specified date, which is futures, that date when it arrives, I will have to receive the physical cash or the physical asset or currency. But we as traders, we don't need the physical assets. Do you understand? All we need is just the profits from these assets, which derivatives come to play. So now what is a derivative? A financial derivative is a tradable product or contract. Now look at the word here, contract, because you can look at the examples that I gave in explaining this financial instrument. The agreement between two people, the buyer and the seller, is called a contract. So that contract is what can be traded via this financial derivative. So I continue. The financial derivative is a tradable product or contract that derives its value from an underlying asset. The underlying asset can be stocks, currencies, commodities, indices. All these are just examples of asset classes. They are assets, and even interest rates. They help investors to remain exposed to price changes of different financial assets without actually owning them. So now a derivative is now a platform where we can now trade currencies without owning them. We just trade them. We trade them and we get the profits. Let me give an example. For futures, I have an agreement with you now, who is the farmer. You sell cocoyam, and then we have an agreed contract where there's a set price which I would receive cocoyam from you at a specified date. I can take this contract and say, okay, I want to sell this contract to someone else who needs cocoyam. Let's say I don't need the cocoyam again. So I will sell it to somebody and add my own profit inside. So let's say this person wants this contract because he sees that he's able to buy one cocoyam for $3. I think that was the price we used. So he sees that's a very good opportunity. So I will sell it to him. So this contract now, instead, I won't sell it for one cocoyam for $3. I will sell it for one cocoyam, $3.50. So that 50 cents will be my profit. And mind you, I'm not ordering just one cocoyam. I might be ordering 20, 30, or even 50 cocoyams. So each cocoyam will now be sold for him for $3.50. That 50 cents multiplied by the amount of cocoyam that I will be receiving. This is what I'm selling to him. I hope you understand. So therefore, this saves us from actually owning the financial asset physically. We just make our transactions without owning them. So I hope you understand. All right, Forex quotes. How to read Forex quotes. Currencies are always quoted in pairs, such as CAD USD or USD yen. In our last lecture, I explained to us that in order to trade currency, you have to trade them in pairs. The reason they are quoted in pairs is that in every foreign exchange transaction, you are simultaneously buying one currency and selling another. So we can take, for example, here, British pound USD. If you are buying this pair, what happens? It means you are buying British pound and you are selling USD. You are using USD to buy British pound. So now there's a system for naming, and I said it in the last lecture. The first currency is called the base currency. And then the second currency is called the quote currency, like you can see here. And this number represents the rate. The base currency is a reference element for the exchange rate of the currency pair. It always has a value of 1. So what this means is that, let me write it here. 1 unit of British pounds is equivalent to $1.21228. That's what it means. So this is in units. This is the value. This is USD. That is United States dollar. This is the price of 1 British pound. So I hope we get it. It's just very, very simple. Let's move. An exchange rate is simply the ratio of one currency valued against another currency. So I just brought this here so that we get it. This number we are seeing is the exchange rate. It's just telling you the value of one currency in this currency. So the value of British pound, of 1 unit of British pound, is this. So it's 1.21 cents USD. How is money made in Forex trading? How do you make money? Buying and selling. Simple. It's either you buy or you sell. You can make money in 2 ways. Now, this is one advantage we have over stocks. Now, you can also trade stocks with the financial instruments which are listed below, above. But I will not go into that so that we don't get confused. We just take it one after the other. Buying. When buying currency, the exchange rate indicates how many units of the quote currency are required to purchase a single unit of the base currency. So like I explained before, I want to bring to our attention that buying also means long, selling also means short. So most traders, they use the word long. You can hear someone say, I went long on Euro USD. I went short on British pounds USD. So it's just for us to take note of that. So this is just explaining what I explained in the previous slide. When buying a currency, that exchange rate is just telling you how many units of the quote currency are required to purchase a single unit of the base currency. So let me still explain it again so that to make sure that we all get it. So I'm going to use Euro USD again. Or let me use our the Nigerian naira. So let's say the rate of USD and Nigerian naira is 1,400. What does this mean? It means you need 1,400 to get 1 USD. Very simple. So if you are trading this pair, it means that the price that you see is the price for 1 USD. So I don't know. I don't need to explain any further. The same thing for selling is the reverse. When you sell, the exchange rate indicates how much of the quote currency you can receive in exchange for 1 unit of the base currency. So the base currency is one in front, the quote currency is the one that you see on the other side. What is Forex trading? I'll still talk about it again. Forex trading, also known as FX. So this FX, F stands for foreign, then X is exchange. Forex. For means foreign, then EX means exchange. The Forex market refers to the global market where banks, institutions, individuals speculate on the exchange rate between fiat currencies. As a Forex trader, you are predicting or you are speculating whether the value of one currency will increase or decrease compared to another currency. So Forex trading can be defined as the process of speculating on currency prices to try and make a profit. The value of a currency is influenced by economic, political, geopolitical events, and financial flows, trade and financial flows. So this is self-explanatory. Money is made in Forex by buying and selling currencies. And this buying and selling of currencies, they have to be done at different rates. Like in the previous class, I explained and I even give an example. But yeah, I'm also going to give an example so that we get it. Now, there are two ways to make money in Forex. Is either you go long or you go short. But then these two ways have to be paired with something. So let me explain. Number one, buying a currency at a lower price and then selling it at a higher price. It means that when you are buying a pair, you have to hope that it it goes up in value. It's very simple. If I buy an iPhone for $200 and I want to make profit from it, it has to increase in value before I sell it. So you buy low, sell high. Then the reverse is for selling. You sell a currency at a higher price and then buy it back at a lower price. Okay, so I'm going to give an example so that you understand it better. Euro, USD. If I buy this pair, what am I doing? I am buying euro and selling USD. If I'm buying euro, I'm using USD to buy it. So therefore, I'm selling USD. Simple. So now, if the price is at, let's say, €1 is equivalent to $1, and then it increases in price, 1 unit of euro is now equivalent to $2. What happens? And I actually bought euro. So since I have the euro, I will now sell it to buy dollar because I used $1 to buy €1. Now, because I still have the €1, 1 unit of euro, and it is trading at $2. This is now the price. So if I sell my 1 unit, which I bought before, I will now gain $2. So what happened? I've made profits of $2 here. I think it should be very, very simple. Okay. So now, let's now talk about selling. Still using the same Euro, USD. If I sell this pair, what does that mean? I am selling Euro, I'm buying USD. If I'm buying USD, what am I using to buy it? I'm using the Euro to buy it. So I'm using Euro to buy it, means I'm selling the Euro and then buying USD. Okay. Why am I selling? I'm hoping that price will reduce. So let's say €1 is trading for 1 USD, or so that we can, it's to be easier for us. Let's say €1 is 1 unit of euro is trading for 4 USD. Then it goes down in value. That is, the euro now goes down in value. €1 is now trading for 1 USD. Now you can see what they say there. Selling a currency at a high price. This is the price of euro. Euro is high. The price for euro is 4 USD. And then buying it back at a lower price. Look at what now happens. I sold euro. So when euro now goes down, because €1 is $4. So if I sell euro, I have in my pocket or in possession, I have what? 4 USD. That's what I have now because I sold the euro. So when euro now goes down in value, what happened? I will now use 4 USD to buy the 1 unit of euro, which is now equals to 1 USD. So how many units of euro will I have? I will have 4 units. Before I had 1 unit, which was what I sold and got 4 USD. Now I have 4 units. So now, because I have 4 units of euro, my broker will now help me convert this euro to what? to dollar because I cannot withdraw euro. Now, it depends on your broker. If you are trading with the euro currency, then you'll be able to withdraw in euro currency. But most brokerage firm, they trade with euro with the dollar USD, with the USD, with the trade in dollar. So now 4 units, if you are converting it back to dollar, because 1 euro is equals to 4 USD. So if you're converting it back to dollar, you have 4 USD. So this is your profits. So I hope we understand. If we don't understand this, we will just comment in the group so that I will do a video just to explain this. But this is just, it's very easy, it's very simple. But it's actually important that we understand this. Good. The profit made by the trader is the difference between between the two prices minus any transaction costs or fees. So the profit that is made if you buy is the difference between the previous price it was before and then the higher price it is now. Then if you sell, the profit that you make is the price it was before, then and minus the lower price it is now. So that's how you make money after subtracting the transaction cost and fees. So there are other fees you pay for making transactions. We have commissions, we have spread. So we're going to talk about that in subsequent lectures. When you buy in a trade, you sell by closing the trade. When you sell in a trade, you buy by closing the position. This is termed liquidating your position. Okay. Now let me explain this further. Using an example, the same example again, Euro USD. When you buy this pair, you're actually buying Euro and selling USD. So you buy. Then when you close the trade, what happens? You do the reverse. You sell the Euro and then you buy USD back. You buy this USD back. That's what it means. When you close the trade, so if you enter a trade, either you are buying or selling, when you close the trade, you are doing the reverse. So it's very, very simple. Whenever you close the trade, you do the reverse. Okay. Okay, this is an example I just left in the notes so that when you are going through the note, you can be able to digest the information properly. In our previous note, we have this. So I won't go over it again here because I already explained it in the previous lecture. These are the things that drive the interest rate. So we're going to be talking about the fundamentals in Forex trading. Fundamentals is one of the ways to speculate the market. Is where we pull in different things in order to determine where price is likely to go. And these include news about the interest rate, inflation, the political stability, how is the economy doing, and various other things. So we're going to talk about interest rates today. Now, there's something called the interest rate cycle. Now, I listed these entities here to point out the characters that play in the interest rate cycle. Okay, so now, before we go on, I would like us to understand that banks, actually, they make their profit from loans, from debt. Another thing I also want to explain to us is that economy simply measures the flow of money. When there is enough cash to flow from one individual to another, it measures how good the economy is. And now you can remember a time in Nigeria when there was limited cash flow. It affected the economy. So economy simply just measures the flow of money. And that's where we get the word currency, current, the flow. Money has to flow from one hand to another. It's when money is flowing, it's good for the economy. And then for money to flow, it depends heavily on banks to print money and also to give out money. And how banks give out money? They give out money in loans. So now I explained before that banks make their profit from debt, from loans. When they give out money to an individual or a body or a corporation or the government or businesses, they expect that this individual or business will pay them the money with profits. So that interest is where they get their own profit from. So now, banks are the entities that play a role in making sure that cash flows in the system. So we can therefore say that the economy strives by debt. So the more debt banks give, the more money flows in the system and the more is good for economy. Okay, now, there's something called interest rates, which I I've been saying since. Interest rate is the percentage that is paid for taking a loan. And you should understand that banks, which are the commercial banks, they take loans from the central bank. The central banks are the ones that are assigned the role of printing money. Commercial banks don't print money. Central banks are the ones that print money. So we're going to be using an example here to explain this whole thing. And then we're going to use the Central Bank of United States. They're also called the Feds. They actually are a huge factor that control the value of the United States dollar. And then also because dollar is king, it has huge effects in the whole world's economy because many goods are traded in the US dollar, especially oil, crude oil is traded in US dollar, and some other things are also traded in US dollar. So it affects the economy too, stock market and every other thing. Now, when the economy is booming, meaning that there is flow of money, there's flow of currencies. And why is it flow of currencies? Because banks can go and take loan from the central bank, and then these commercial banks to also give out loan to businesses, big businesses, and also individuals. So now let's say the interest rate for set by the central bank to other commercial bank is 3%. These commercial banks will also set the interest rate at a higher rate of 5% because they also want to gain money. If they borrow money from the central bank, they'll have to pay back and they pay with interest. So they will now have to increase their own interest rates. So now individuals and then individuals and then businesses, they come to lend money from banks because they want to increase their productivity in their company. And then if the company increases in productivity, it increases in value, it needs people to come and facilitate its growth and activities. So there will be high employment. So people will be employed. And when people are employed, they will be paid their salaries. And if they are paid salaries, what happens? There's a huge amount of money for people to use to buy things. So there's huge and increased spending in the system. So this system will now cause what they call inflation because now there's enough money and there's high demand. But because the goods and services are limited, what happened? The law of supply and demand, the price will increase, and this price will cause inflation in the system. And then because there's inflation, people will now go and borrow more. They will now borrow more. Businesses, normally, let's say real estate businesses, to buy cement, the price has actually increased. So for them to build other houses, they have to go and borrow more money from the bank because now there's inflation. So now this inflation and increased borrowing will cause the central bank to increase the interest rate. This interest rate is so that they can control inflation. And when the interest rate is increased, it will discourage lenders from coming to lend, meaning that individuals, businesses will not come and take loans to facilitate or grow their businesses. They will now do something what they call layoff. Instead of taking more loans, they will have to conserve and lay off some employees because now they don't have enough money to pay their employees. They will now have to lay them off. And when they lay them off, the economy slows down. How does it slow down? People are unemployed. They don't have enough money to buy things. Now the cash flow has reduced. Now, as cash flow reduces, it reduces inflation. So the price will now have to go down in value. And if it is not properly done, if the central banks don't come in, it can lead to what they call deflation. As you can see here, the economy slows. So because of that, the central banks will now lower the interest rate so that it will now encourage lenders, so that businesses can now come and lend money and expand their business and bring in more people to be employed, and then people can also borrow money and be able to buy things. So like that, because this economy is now weak. So if they want to increase it, so what happens? There's more business investment, they encourage consumer spending, and then like that, it makes the economy to improve, meaning there's more flow of money like that, and that's how the cycle continues. So we need to understand this rule of interest rates. This helps to tell us the value because, like I explained before in the previous lecture, high interest rates tends to explain how expensive a currency is. So if the interest rate is very high and the inflation rate is well controlled, it means good for the currency. So high interest rate is very good, but not that good because the interest rate can be too high to the point that it leads to deflation and can be bad for the economy. But a stable interest rates with a stable inflation, with good employment, with good money flow, it's good for the currency. So when you're analyzing a country's currency, you use these factors, these variables, to tell if the currency is doing well and has a potential of doing better in the future. So now I know we are just learning Forex, but it's good we have a broad view of the market. Forex is not as you may think it is, where you just come in, just gamble, or you take it as a game. You have to understand because it's a business where you have to bring so many factors in speculating. Now, many of you may go into fundamentals, and then some of you may actually go into the technicals, and some of you may use the two. I know of people that use it. I as well too. I try to combine the two. But one thing I want to also explain to us is that fundamental is more of the long term. Why technical is is short term. Technical has to do with what you see on the chart. You can just form a strategy. You look at historic data in time past, and then you determine if the market is going up or going down, or if you should enter the market or not. But fundamentals, it doesn't really obey the technicals. It's long term. You can say, okay, in 3 months to come or in a year to come, the currency of this country will increase in value, but you may not see it in the chart. So most people, they combine the two. So it's good that some of us have this understanding of the fundamentals of how interest rates, how the economy, how central banks affect the economy, how businesses affect the economy. Now, I wouldn't want to go deep into these things because you don't really need much of these things just to trade. It's just an overview. So now we're going to talk about the essential terminologies. When it's good, we become conversant with these terminologies. What is ax? The ax is the price at which your broker will sell the base currency in exchange for the quote currency. This means the ax price is the best available price at which you can buy from the market. The ax price is just the price that you can buy. So now, the ax price is what price can you ask for this currency? Very simple. So if you want to buy something, the broker will sell or offer it to you at the ask price. Then there's something called the bid. The bid price is the price at which your broker is willing to buy it, to buy the base currency in exchange for the quote currency. So is the price at which you can sell, and is the price at which your broker can buy it. It's just very, very simple. Very simple. Now, there's something called spread. What is spread? Spread is the difference between the bid and the ask price. So like you can see here, the bid price, the ask price, this is the ask price, and then this is the bid price. But you can see that they are different. 1.3456, 1.3458. So these two prices, the difference between them is 2.0, which is the spread. Very simple. And this is how brokers make money. Okay, so now let me give an example so we understand it better. Now let's say I sell iPhones, and then you came to my shop and then bought this iPhone for $200,000. Okay, so now let's say you want to sell the phone back to me. You won't sell it back to me for $200,000. I won't collect it for $200,000. The price, which will be my ask price, will be lower than $200,000. Let's say $199,000. Why? Because I want to gain from that purchase. And also, you are paying me for my services. I supply iPhones. I make it available. I take care of the risks because let's say iPhones are produced in another country. I transport it from that country to where we are in Nigeria, for example. So because of those risks, which I take ownership of, you will have to pay me for my services. So now, in trading Forex, the spread size is usually small. You can see it, 2 pips. It's actually very small. It will become significant when we talk about leverage, which we'll talk in the next lecture, where we'll be discussing pips and lot size. You will learn about risk management in the next lecture. So not to go deep and get you confused, just understand that spread is just the difference between the bid price and the ask price.